This chart tracks Bitcoin's historical 4-year halving cycles. For a decade, investors learned a pattern. Each halving tightened supply, triggering a predictable upward price trajectory. Then, early 2026 wiped out $1.2 trillion. Actual price violently breaks away, dropping from $126,000 to $61,000. Financial commentators reacted to the sudden drop by declaring the bull market over, running familiar headlines that cryptocurrency had finally died. But the on-chain infrastructure tells a very different story. In 2024, stablecoins settled $27.6 trillion in value. That outpaces the annual transaction volume of Visa and MasterCard combined. The market no longer answers to retail hype and halving scarcity. When spot ETF inflows routinely outweigh the daily supply produced by miners, institutional infrastructure dictates where the capital flows. What died in 2026 was unchecked retail speculation. The remaining market is a maturing, macro-driven environment. Surviving it requires a completely revised approach to allocation. To understand the 2026 crash, we have to look at the Federal Reserve. Macroeconomic forces and hawkish central bank policies triggered a massive global liquidity drain. When Kevin Warsh was nominated as Fed chair, Treasury yields surged. This drained the accessible, low-cost capital that had reliably fueled previous crypto rallies. Wall Street treats Bitcoin as a highly liquid macro asset. When traditional equities bleed and fund managers need cash immediately, they sell their most liquid holdings first, turning Bitcoin into a real-time liquidity barometer. Spot ETF capital inflows now dictate market direction. Wall Street fund movements absorb and deploy capital at a scale that completely overshadows the supply restrictions of the halving event. At the same time, major Bitcoin miners like Hut 8 and Iron secured billions in AI computing contracts. By repurposing their infrastructure for artificial intelligence, they secured guaranteed revenue, removing the need to sell off Bitcoin to cover operating costs. Treating Bitcoin as an isolated asset tied to a 4-year clock is dangerous. Investors must now analyze it as an asset heavily correlated with global fiat liquidity. High-profile fraud collapses and bankruptcies ended the era of unregulated offshore exchanges. Billions in lost customer funds forced governments worldwide to mandate strict oversight. The European Union responded with the MiCA regulation. As of July 1, 2026, any crypto asset service provider operating in the EU without proper authorization must cease operations completely. Meanwhile, the United States issued a joint ruling in 2026 that divided oversight of digital commodities between the SEC and the CFTC, clarifying exactly which agencies control specific assets. The U.S. also implemented the Genius Act. Any stablecoin issuer operating in the States must now maintain one-to-one fiat backing, hold verifiable reserves, and submit to regular, independent audits. For active traders, using offshore or non-compliant platforms introduces immediate risk. You face sudden stablecoin delistings, suspended trading pairs, and frozen liquidity if your exchange fails a regulatory audit. Compliance dictates market access. Respecting the regulatory perimeter is a mandatory requirement to prevent your capital from being locked out of your own jurisdiction. The fastest-growing sector of the 2026 market doesn't involve native cryptocurrencies at all. Traditional finance is migrating onto the blockchain through the tokenization of real-world assets. In April 2026, Morgan Stanley launched its dedicated tokenized fund. Major banks now use crypto rails to issue private credit and settle government debt. This side-by-side comparison table contrasts tokenized real estate with traditional REITs. Tokenization replaces days-long settlement windows with instant 24/7 liquidity and allows fractional ownership at much lower minimum investments. Vocal backing from traditional asset managers removed the reputational risk associated with blockchain. For major corporate institutions, integrating digital ledgers is now a standard operational requirement. The trade-off is straightforward. Tokenized assets will not deliver the massive, volatile returns of early altcoins. They provide institutional safety and highly efficient yield. High net worth capital utilizes the digital asset market to upgrade the speed and efficiency of traditional financial instruments, leaving pure token speculation behind. This quadrant chart plots assets like Bitcoin, MiCA stablecoins, and real-world assets against their regulatory risk and institutional adoption. Deciding where your portfolio belongs requires matching your capital to the right quadrant. Looking at this decision tree flowchart, The first path addresses the everyday, long-term retail investor. If your primary goal is a long-term store of value, your capital belongs in U.S. spot ETFs or strict self-custody. The second branch follows the active professional trader. If you require frequent execution and leverage, you need to relocate your trading operations to MiCA-authorized EU platforms. The third branch covers high net worth and TradFi allocators. If your priority is yield generation, your capital should flow into tokenized real-world assets. This path maximizes safety and inflation protection. In exchange, you accept a slow, grinding, macro-driven growth curve rather than sudden, explosive gains. You gain legal clarity and cross-border passporting privileges, but the cost is heavy KYC friction and constant monitoring of your stablecoin pair's compliance status. You secure unparalleled settlement speed for traditional debt and equity. However, you assume emerging smart contract vulnerabilities and platform custody risks. The unregulated casino era is closed. Select a specific lane, adhere to the new compliance guardrails, and you can safely deploy capital in the digital economy's institutional era.